Patterns in trading are one of the most widely used and mainstream forms of forecasting potential future market moves. The problem is, people often misidentify them and misuse them, not getting their full potential. So let's take a look into triangle patterns and see how you can use them to maximize your trading profits. So firstly, what actually is a pattern? Patterns aren't just funny shapes on a chart. They reveal market bias and psychology. Triangles often consist of one trend line and one support or resistance level, forming the apex. Just like we've covered before in our trend lines video, we generally need 3 touches of any line to confirm its significance. Let's take a look here. There is a clear support the price has bounced off multiple times, and we see this downward sloping resistance line forming a descending triangle. This is a bearish pattern, but why is it bearish? This is because every time the bulls push the price up, they push it with less and less force, forming this downward sloping resistance line. Therefore, the bears are pushing with a constant force, and the bulls are pushing with a weakening one. So using this logic, eventually the bulls cannot push back anymore, and we will fall through the bottom of our triangle. Generally with triangle patterns, our natural target is the width of the start of our triangle, making this a very easy level to calculate and locate. Most triangles have their opposite partners. We also have ascending triangles where bulls retest a resistance level in the market, and the bears each push weaken in strength, forming an upward sloping support. The other major type of triangle are wedges, and we have rising and falling ones. Now, these don't use horizontal supports and resistances. Here, the magic lies in the angles. So let's take a look at a rising wedge pattern. Despite it moving up in price, it's a bearish pattern. But why? Let's take a look at the 2 trend lines that form the rising wedge. The key here is the lower trend line that forms the base has a steeper gradient than our upper trend line. But why is that significant? Generally in trading, the steeper a trend line is, the less relevant and less strong it is. This is because the bulls or bears in this case are unable to hold the same level as well. So between the 2 trend lines that form our upwards rising wedge, the upper one is stronger and shows the bears are stronger than the bulls. Therefore, we are more likely to see a downwards break, and of course, we target the width of the entry of the wedge. And of course, we also have falling wedges, where the opposite is the case, and the upper trend line is weaker and the lower is stronger, meaning the bulls are stronger in this case. Finally, we also have symmetric triangles, which are generally speaking equilibrium patterns, where neither the bulls or bears are in control. These consist of 2 equally angled trend lines, forming a central apex. Generally speaking, with these types of patterns, the context matters. If we see one of these occurring in an uptrend, it's more likely to be a bullish continuation, and in a downtrend, it's more likely to see a bearish break. If you don't like drawing and locating patterns manually, guess what? ChartPrime Pro and Plus users both have automatic pattern detection, where patterns are automatically labeled on your chart along with the breakout signal and targets, making your life even easier. Using patterns and trend lines can be one of the most powerful and classical ways to analyze a market, and can really give you an edge over other trading methods as they rely on breakouts. So, if you enjoyed this video and want to see more content like this, don't forget to subscribe and join our Discord.